We'd like to share with you some of the advanced tax strategies we're using for some of our higher net worth clients. I'm John Momartz. I'm the managing partner at the Carson Wealth Office in Marquette, Michigan. So what if we could reduce your tax cost in your taxable brokerage accounts? Studies have shown that for most investors in taxable accounts, they're going to lose about 1 to 2% per year in total return due to trading, income, etc. And that's something we're striving to reduce. Two of the main strategies that we use are Flex and Tax-Aware Delphi Plus. The Flex strategy is an overlay to an existing brokerage account where we can generate pretty significant net capital losses to offset any gains that we need to do within that trading account or any gains that the client may have had in a business sale, etc. And Tax-Aware Delphi Plus is a strategy where we can generate some significant ordinary income losses that offset your ordinary income directly up to certain IRS limits. Our objective is to create a diversified asset allocation solution with the intent for the after-tax return of the portfolio to at least equal the pre-tax return. We're trying to reduce that tax drag and potentially add future tax alpha assets that can be used again to offset future gains. So let's just use an example here of a traditional brokerage account, and we'll use a 60-40 portfolio as an example. And if we were to assume in that 60% equity position, we're going to get an 8% average annual return on the stocks. On the bond portion, say 30% of the portfolio, we're going to get about a 4% average annual return, and the cash about a 3% average annual return. When you boil that all down, you'll see about a 6.3% gross rate of return on that 60-40 portfolio. But when you factor in the tax cost, the true after-tax rate of return is only 5.5%. So you lose about 80 basis points due to taxes. One of the strategies we use for higher net worth clients is to take that same 60-40 portfolio, but implement 30% of that into private assets. And if we do that, we break those private assets down into private equity, private credit, and real assets, which could include infrastructure projects, real estate, etc. And if we do that, those private assets will actually generate a little bit greater return. But at the same point, some of those are tax inefficient. But because of the greater return on those private assets, we can generate a higher net after-tax rate of return of 5.9% versus 5.5% for your standard 60-40 portfolio, because that gross rate of return is much higher, but there's still a tax drag even when we use the private assets. So here's our Flex strategy as an example of how this may work. So what we're doing is we're taking an existing brokerage account and overlaying some trading on top of that using some leverage to maintain a market neutral stance. So we don't have to worry about the margin call situation. But what we're doing here is using, again, some private assets, the existing brokerage accounts, but we're generating these net capital losses to enhance the post-tax rate of return. And by doing that, you can see in this example, using this 250-150 strategy, the pre-tax rate of return is up to 9.4%. And when you factor in the net capital losses and ordinary losses we've been able to generate with Delphi Plus and Flex, the after-tax rate of return is 11.1%. So we've generated 1.7% a year of tax alpha. And I'll get into the details of this in a future presentation. So here's a summary of kind of the three different strategies that we talked about if we use a $10 million portfolio to start. And the first column is using public assets only, your traditional 60-40 portfolio with a pre-tax rate of return of 6.3% and an after-tax rate of return of 5.5%. You've got your tax drag of 80 basis points. Over a 10-year time horizon, that $10 million would grow to be $18,421,000. But once you factor in taxes, you've got $17,032,000 left. Still decent numbers. If we add in the private assets for our high net worth clients, we are able to generate that higher rate of return of 7.2%, but we still have some significant tax drag. But we do net a 5.9% post-tax return, which is better by using the private assets. So that $10 million has grown to be $20 million pre-tax and $17.7 million after tax. Still a little bit better than the standard 60-40 portfolio. But when we throw in our tax beneficial moderate allocation using Flex and Delphi Plus, that pre-tax rate of return jumps up to 9.4% and the after-tax return to 11.1%. So that $10 million portfolio has grown to be $24 million before taxes. And after taxes, it's grown actually even higher to $28.6 million because we've generated additional capital losses and ordinary losses that can be used to offset other gains in other areas or future gains from this portfolio. So it can generate significant tax benefits. It can create tax deferral and potentially avoid taxes down the line. And we can talk in the future about how those strategies will work. And here's our disclosures.